Hey everyone, and welcome back to the channel. Today, we diving deep into a topic that might sound complicated but is a massive part of the crypto world, derivatives. Specifically, we're going to break down crypto options and futures in a way that actually makes sense. So, if you've ever heard these terms thrown around and wondered what on earth people are talking about, you're in the right place. Stick around, and by the end of this video, you'll have a solid grasp of what they are and how they work. First things first, what even is a derivative? Don't let the fancy name scare you. A derivative is simply a financial contract that gets its value from an underlying asset. Think of it like a ticket to a concert. The ticket itself has value, but that value is derived from the actual event, the concert. If the band becomes more popular, the ticket's value might go up. If they cancel the show, the ticket becomes worthless. In the crypto world, the concert is a cryptocurrency like Bitcoin or Ethereum, and the ticket is the derivative contract. So, crypto derivatives are contracts whose value depends on the price of a specific cryptocurrency. People use them for a few key reasons: to speculate on future price movements without actually owning the coin, or to hedge, which is a fancy way of saying they want to protect their existing crypto holdings from potential price drops. It's all about managing risk and creating opportunities. Now, let's get into the two big players, futures and options. We'll start with futures. A crypto futures contract is a legally binding agreement to buy or sell a specific amount of a cryptocurrency at a predetermined price on a specific date in the future. Let's break that down with an example. Imagine you believe the price of Bitcoin is going to rise over the next 3 months. You could buy a Bitcoin futures contract today that agrees to buy 1 Bitcoin in 3 months for, let's say, $65,000. If, in 3 months, the actual market price of Bitcoin is $70,000, you've made a profit. You get to buy it for $65,000 as agreed and could immediately sell it for $70,000. On the flip side, if the price drops to $60,000, you're still obligated to buy it at $65,000, meaning you face a loss. It works the other way too. If you think the price will fall, you can short a futures contract, agreeing to sell Bitcoin at a future date. If the price does fall, you can buy it cheaper on the market to fulfill your contract and pocket the difference. The key thing to remember with futures is the obligation. You have asterisk to buy or sell. So, if futures are about obligation, crypto options are all about well options. An options contract gives the buyer the right asterisk, but not the obligation to buy or sell a cryptocurrency at a set price, known as the strike price before a certain expiration date. This is a crucial difference. With options, you have the choice to walk away. There are two main types of options: call options and put options. A call option gives you the right to asterisk buy asterisk. You'd buy a call option if you're bullish, meaning you think the price will go up. For example, you buy a call option for Ethereum with a strike price of $4,000. If ETH shoots up to 4,500, you can exercise your option, buy it for 4,000, and you're in the money. If the price stays below 4,000, you can simply let the option expire. You only lose the small fee you paid for the option itself, called the premium. This limits your potential loss. On the other side, we have put options. A put option gives you the right to asterisk sell asterisk. You'd buy a put if you're bearish, thinking the price will go down. Let's say you own some Bitcoin and you're worried about a potential price drop. You could buy a put option with a strike price of $60,000. If the market price of Bitcoin falls to $55,000, your put option is valuable. It gives you the right to sell your Bitcoin for $60,000, protecting you from that $5,000 loss. If the price goes up instead, great. You just let the put option expire, losing only the small premium you paid. So, puts are a fantastic tool for hedging, acting like an insurance policy for your crypto portfolio. The premium you pay for the option is like your insurance payment. You hope you don't have to use it, but you're glad it's there if you do. Let's quickly recap the main difference, because this is the most important part. Futures contracts are an asterisk obligation asterisk. You are locked into buying or selling at the agreed upon price, which means your potential for profit or loss is theoretically unlimited. Options contracts, however, give you the asterisk right asterisk, but not the obligation. Your risk is limited to the premium you paid for the contract. This makes options a more flexible, and for some, a less risky way to speculate or hedge. Think of it like this. A futures contract is like promising your friend you'll buy their concert ticket for a set price, no matter what. An options contract is like paying your friend a small fee to hold the ticket for you, giving you the first right to buy it at that price if you still want to later. If you change your mind, you just lose the small fee. So why do people even use these complex tools? One of the biggest reasons is leverage. Derivatives allow you to control a large amount of cryptocurrency with a relatively small amount of capital. For example, with a small deposit, you might be able to open a futures position worth 10 times that amount. This can amplify your profits significantly if you're right. And this is a huge, but it also amplifies your losses. Leverage is a double-edged sword and is extremely risky, especially in a volatile market like crypto. It's why you often hear stories of traders getting liquidated, where their initial deposit is wiped out completely because the market moved against them. This is not a game for beginners, and it's crucial to understand the risks fully before even considering using leverage. Another key use, as we've touched on, is hedging. Imagine you're a crypto miner. Your revenue is in crypto, but your costs, like electricity, are in traditional currency. A price crash in crypto could be devastating for your business. To protect against this, you could use futures or options to lock in a selling price for the crypto you expect to mine in the future. This helps you stabilize your income and manage your business risks, making your revenue stream more predictable. It's not just about wild speculation. Derivatives are a vital financial tool for businesses operating in the crypto space. They bring a level of financial stability and planning that would otherwise be impossible with such volatile assets. Now, you might be wondering where you can trade these things. Crypto derivatives are traded on specialized exchanges. Many of the major cryptocurrency exchanges you already know offer derivatives trading, but there are also platforms that focus exclusively on them. When choosing a platform, it's vital to look at things like their security, liquidity, meaning how easy it is to buy and sell, the fees they charge, and their reputation. It's also important to note that the regulation of crypto derivatives varies hugely from country to country. In some places, they are heavily regulated, while in others, they may not be permitted for retail traders at all. Always do your own research and make sure you're complying with your local laws and regulations before you start. To sum it all up, crypto derivatives like futures and options are powerful financial instruments. They derive their value from an underlying cryptocurrency and allow traders to speculate on price movements or hedge against risk. Futures lock you into an obligation to buy or sell, offering high potential rewards but also high risks. Options give you the right but not the obligation, offering more flexibility and limited downside risk confined to the premium paid. While they open up sophisticated trading and risk management strategies and can offer amplification through leverage, they are complex and carry significant risk. They are definitely not something to jump into without a deep understanding. My advice? If you're new to crypto, focus on understanding the basics of spot trading, just buying and holding the actual coins first. Get comfortable with the market's volatility before you even think about exploring the world of derivatives. And that's our deep dive into crypto futures and options. I hope this broke it down in a way that was clear and helpful. It's a complex topic, but understanding the fundamentals is a huge step. If you found this video valuable, please give it a big thumbs up. It really helps the channel. And if you have any questions, drop them in the comments below. I'll do my best to answer them. Don't forget to subscribe and hit that notification bell so you don't miss our next video. Thanks for watching, and see you in the next one.